Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Antero Resources Corporation Annual Report. Antero Resources Corporation offers a diverse range of businesses and services related to the oil and natural gas industry. The company's primary focus is on the development, production, exploration, and acquisition of natural gas liquids, NGLs, and oil properties in the United States. The company operates through three main segments: exploration and production, marketing, and equity method investment in Antero Midstream. In the exploration and production segment, Antero Resources Corporation engages in the development and production of natural gas and oil properties. This includes the operation of gathering and compression systems, which comprise 708 miles of gas gathering pipelines in the Appalachian Basin. The company's services also include marketing, where it sells its products to various customers. Additionally, Antero Resources Corporation has an equity method investment in Antero Midstream, a subsidiary that provides midstream services such as gathering, processing, and transportation of natural gas and NGLs. In terms of geographical presence, the company operates in two main regions: the Appalachian Basin, where it holds approximately 521,000 net acres, and the Upper Devonian Shale, where it has around 170,000 net acres. Overall, Antero Resources Corporation services cater to various aspects of the oil and natural gas industry, from exploration and production to marketing and midstream operations. The stock price of Antero Resources Corp has experienced a significant decline over the past year, with a 14.17% change in value. Several news events and periods of underperformance have contributed to this downward pressure on the stock. One notable period of concern occurred when the company announced its fourth quarter 2025 financial results, which missed analyst expectations for adjusted earnings per share, EPS. Additionally, the realized natural gas liquids price premiums fell by half compared to the previous year. This combination of disappointing news led to a 12% drop in the stock's value. Earlier in the year, Antero Resources stock underperformed the S&P 500, with a minus 4.39% return compared to the index's minus 2.43% decline. Downward revisions of revenue expectations for the full fiscal year 2025 also contributed to cautious investor sentiment, leading to a 5.32% drop in the stock price. The cumulative effect of these events has resulted in a significant decline in Antero Resources Corp's stock price over the past year. Antero Resources Corporation market capitalization of $11 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Antero Resources Corporation holds a significant advantage in their industry. Antero Resources Corporation trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 1.47 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 45% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for Antero Resources Corporation in 2025 can be attributed to the significant increase in natural gas sales. The company's revenue from natural gas sales rose by 58% compared to the previous year, contributing substantially to the overall revenue growth of 22%. This substantial increase in natural gas sales is likely due to a combination of factors such as increased production levels, higher prices, or both. In contrast, the decline in oil sales and natural gas liquids sales had a relatively minor impact on the company's overall revenue. The decrease in oil sales was particularly pronounced, with a 35% drop from the previous year. However, this decline was more than offset by the substantial growth in natural gas sales, resulting in a net increase in revenue. The strong performance of Antero Resources Corporation can also be attributed to its ability to manage costs effectively, as evidenced by the significant increase in operating income and net income. The company's earnings per share, EPS, also saw a remarkable increase of 1,035% from the previous year, indicating a substantial improvement in profitability. The net income of the company underwent significant changes between 2024 and 2025. Initially, it decreased due to increased regulatory burdens on profitability, lower oil prices in 2025 compared to 2024, and higher interest expenses. However, despite these challenges, the net income surprisingly increased by $608,275 from -$66,297 in 2024 to $541,978 in 2025. The profit margins of the company also experienced changes during this period. They were negatively affected by regulations limiting production, transportation, and sale of natural gas and oil, as well as prolonged low and or significant declines in natural gas, NGLs, and oil prices. Additionally, higher costs of doing business and reduced ability to pursue acquisition opportunities further decreased profit margins. The reasons behind these changes are largely attributed to increased regulatory burdens on profitability, lower oil prices in 2025 compared to 2024, and higher interest expenses. These factors collectively contributed to the fluctuations in net income and profit margins during this period. The company's financial performance is a testament to its ability to generate positive operating cash flow. The data reveals a substantial increase in net cash provided by operating activities, rising from $849,288,000 in 2024 to $1,630,930,000 in 2025. This significant jump indicates that the company has successfully improved its operational efficiency and profitability, resulting in a substantial boost to its cash flow. The upward trend is a clear indication of the company's financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. According to the financial reports, the debt level has decreased from $1.1 billion in 2024 to $1 billion in 2025. This change is particularly evident in the carrying value of senior notes, which decreased by $136,654 from December 31, 2024 to December 31, 2025. In terms of interest expenses, there has been a notable decrease of $34 million, or 29% over the same period. The weighted average interest rate also dropped from 5.9% in 2024 to 5.3% in 2025. However, it's worth noting that an estimated increase in interest expense due to a 1% rise in applicable average interest rates is expected to be $3 million. Overall, the company has experienced a decrease in both debt level and interest expenses over the past year, indicating a positive trend in its financial health. The performance of various segments in the industry has been mixed. On a positive note, regions such as the Appalachian Basin and the Gulf Coast, Atlantic Seaboard, and international markets have shown strong results. The Midwest Chicago regional markets also performed well, driven by growth opportunities. Additionally, the Sherwood 1-13 segment has been a standout performer. In contrast, some segments have struggled to keep pace. The Utica Shale region has underperformed, while the Midwest market via Rover Pipeline has also seen disappointing results. These areas will require focused attention and investment to improve their performance and stay competitive in the industry. Management is optimistic about the company's outlook, citing significant improvements in key financial metrics. Revenue increased by 22% year-over-year, driven primarily by a 58% surge in natural gas sales. Operating income and net income also saw substantial gains, rising by 193% and 621%, respectively. The company's earnings per share, EPS, skyrocketed by 1,035%, further indicating a strong financial performance. The balance sheet reflects the company's growing assets and equity, with total assets reaching $13.2 billion and stockholders' equity standing at $7.7 billion. Management notes that these improvements are largely due to increased production volumes and higher natural gas prices. Looking ahead, management is confident in the company's ability to sustain its growth trajectory. The increase in proved reserves by 665 BCFE in 2025 suggests a strong foundation for future production levels. Additionally, the standardized measure of discounted future net cash flow indicates a significant increase from $3.5 billion in 2024 to $8.1 billion in 2025. Overall, management's outlook is positive, with key financial metrics and reserve growth pointing towards continued success. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the most notable ones include the HG acquisition, which cost $2.8 billion and added 385,000 net acres in the Marcellus Shale in West Virginia to the company's portfolio. Additionally, the HG Midstream acquisition brought in gathering pipelines and integrated water handling assets for $1.1 billion. The company has also made leasehold acreage acquisitions and acquired additional working and royalty interests in certain Antero-operated producing wells. These moves are expected to boost the company's production capacity and revenue. On the divestiture side, the company is set to close a Utica Shale divestiture for an undisclosed amount by February 2026. Furthermore, it has plugged and abandoned older vertical wells that were acquired in conjunction with property purchases. Some lenders have also restricted access to capital or divested from the oil and natural gas industry, which may impact the company's operations. The company's financial activities over the past few years have been notable for its share buyback program. In fact, it has actively engaged in buying back shares under an authorized share repurchase program since December 31, 2023. This initiative demonstrates the company's commitment to returning value to its shareholders. In terms of specifics, the company had authorized a significant amount of $2 billion for share buybacks. During this period, it successfully repurchased 32 million shares at a total cost of $1.1 billion. These actions are indicative of the company's efforts to boost shareholder value through strategic financial decisions. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal concerns about inventory buildup and supply chain disruption that could impact the business. One concern is related to inventory buildup, specifically on page 13, where it is mentioned that if leases covering 29 BCFE are not renewed prior to scheduled drilling dates, future development costs may be reduced. However, a more significant concern is related to supply chain disruption. On page 33, there is a potential for substantial discounts in natural gas, NGLs, and oil prices due to insufficient midstream infrastructure capacity. This could lead to risks associated with third-party transportation services, including availability of capital, materials, and qualified contractors. Furthermore, on page 60, global supply chain disruptions due to trade sanctions, tariffs, and conflicts have caused pressure on global supplies. Additionally, world health events may cause disruptions to the business and operational plans, including interruption of supplies from third parties, page 37. These concerns highlight the potential risks associated with inventory buildup and supply chain disruption that could impact the business's operations. That concludes the financial summary for Antero Resources Corporation. Feel free to comment below, and I will be happy to answer them when possible.